Welcome to Unscripted with Jeff Pedowitz. I sit down with remarkable people from very different worlds, security and science, business and medicine, technology and the arts, for honest conversations about AI and where it's taking us. No scripts, no talking points, just what they actually think. I'm Jeff Pedowitz. Let's get into it.
My guest today helped run Meter, the organization that tested whether OpenAI's and Anthropic's models were too dangerous to release. Then he left to build something stranger, insurance for AI. Rajiv Dattani is an Oxford-trained economist and a former McKinsey insurance partner. And now he spends his days on one question. Can you actually put a price on the risk of a machine that thinks? So he's seen both sides, whether those systems are safe and who pays for it when they're not. And that's where I wanted to go. Rajiv, welcome to Unscripted. Let's get into it.
Thanks for having me.
You got it. So my opening question is, you've been doing this for a long time. Is there a belief that you've held on to that you recently changed?
Yeah, for many years, I think thinking about AI risk felt pretty lonely, honestly. There's a group of people in the Bay in particular who spend a lot of time thinking about it inside the labs. And it felt to me like the rest of the world was kind of a long way behind. In particular, I mean here, the enterprises, the businesses who are adopting AI, and DC, where a lot of folks were not yet thinking about the problem and the kind of magnitude of this. And it feels like now the world's really woken up. It feels like we're with Mythos and everything that's followed since then. It feels like we're now in a paradigm where it's mainstream. Everyone's talking about what is going to happen with AI. What are the risks inherent with it? And I think that's wonderful. I think it's great to have more eyeballs on it, to have more people thinking about it, to have more accountability around it. So I'm excited about the change, and I'm glad I was wrong on that one.
So when you were at Meter, you helped evaluate whether a frontier model was safe to deploy. So what did that actually mean day to day?
Yeah, Meter specifically tests for how capable a model is at effectively self-replicating. And so the way you test for that, so this is the idea of we believe in the very near future there will be AI models that are able to automate a lot of AI R&D research. And when that happens, you could have a paradigm where actually we're no longer constrained on humans working on experiments and how to train the next generation models, but models can do it themselves. And so given the threat, Meter would develop evaluations that were representative of a AI model's capability at conducting software engineering or AI R&D tasks. And they would get early access to a model often, and this is reported in the model cards, and would run these evaluations. And the output you'd get from it would be a score in terms of human hours. And the way to interpret that is, how many hours would it have taken the human to do the task that the AI was able to do, the most capable task the AI was able to do. And the reason this all matters is, as you get AI models that are capable of doing, as you're starting to get now, tasks that would have taken humans 10 hours, 20 hours, 40 hours, suddenly you increase the risk, you increase the likelihood that the next generation of AI models can train the next generation, and so on and so forth. And you get closer to this risky threshold, and that's what Meter outlined in their reports.
So very few people have sat in the chair that asks, is the model too dangerous to release? And then gone on to build the market that prices the answer. So why did you leave the first job for the second?
When you look at past technology waves and risk that's been created by technology, it's often the market that runs ahead in terms of how do you evaluate the risk. And then it's the legislators, the regulators who kind of catch up subsequently. And in particular, insurers have played a really important role in this in the past, because insurers have both the incentives and the resources to actually go out and do this research. And so if you go all the way back to Benjamin Franklin's Philadelphia, when houses are burning down, it was Franklin's fire insurer, the mutual fire insurer, it was America's first fire insurer, who saw the data on what causes houses to burn down, and they started doing effectively audits of houses to say, what materials have you built with, and where are your trees spaced, and how likely is your house to burn down? And then if you've built it safely, then sure, we'll insure you, and you get the trust mark from them, and you get the financial coverage. And that obviously becomes in decades later modern day building codes. And that's an example of the market kind of running ahead. Or a different example is in the 1950s, post World War II, people are dying in highway crashes in America, in car crashes, and it's Progressive, the auto insurer, who said we'll give you a 20% discount on your car insurance premiums if you buy a car with an airbag and a seatbelt in it, much before that becomes federal law. And so we're inspired by this notion of how can the market innovate, and how can you create the market and the private market ecosystem with the funding and with the incentives to actually go out there and find the measures that will actually accelerate security.
I mean, in any insurance model, though, it is fundamentally a loss leader, right? Because even if a company has no claims against its premium, at some point, if they file a claim, especially if it's any of some significance, it would typically outpace the premiums that have been paid, right, by that company. So how, in a world like this, where it's so dynamic and changing all the time, how do you develop a secure economic model that both protects yourself, I guess, as a company, but then still provides adequate runway for the companies that need to be insured?
Yeah, so actually, the first thing to say is we're not the insurers. We work with insurers at Lloyd's of London, which is the world's oldest insurance marketplace. They provide the capacity. They obviously have much stronger balance sheets, and they've been doing this in some cases for centuries. And so they're able to really put the financial backstop behind something like this to protect the companies that we work with. In terms of the model, that what you described, Jeff, can be the case. Really, there's a couple things going on here. One is for insurers to know how to price the risk, it really takes a bit of time. It actually requires them to gather some data and be in the market, and then that's how they see what are the good risks and what are the bad risks. How do we price the risk, and what's working and what isn't? One example is when Uber was still relatively nascent. It was a lot of insurers were kind of nervous about, well, we don't know what the losses are going to look like on this book. The first insurers in were the ones who actually lost money initially. They were writing at quite high combined ratios as it's known in the business, and loss ratios, and eventually they're the ones who then can gather the data. Having gathered that data, they can actually write that book very profitably. And so there's an element of actually just moving first to go out in there and gather the data. The second thing that's different about AI is, whereas in most industries you need to just gather all of the real loss data, in AI you can run what we call evaluations or red teaming and simulate how will the AI system perform in the real world. How likely is it that it will fail? If it fails, how severe will the losses be? And what would that do for a loss distribution on a book of business? And so this is really the first time where you don't need to just only rely on the historical loss data, but you can actually, from the outset, price the policy with some synthetic data that is representative.
Well, because we have a mutual colleague, Reed Blackman, who is a philosopher, but now is getting into just helping companies figure out figure out what problems are going to occur, right, and then solve for that. So is that kind of a similar approach here, where you're trying to figure out, okay, what is the likelihood that something bad will occur, and then you're writing the policy for that?
Yeah, and really the core thing that our customers want is they want the assurance. They don't just want financial risk transfer. They want to know that the system has been rigorously tested by somebody they trust, and it's unlikely to fail. Is the first and foremost. And then if it fails, sure, it would be nice to have financial coverage. But we really see it as that two-step process, and our role is, how do we provide that assurance, and how do we help enterprise buyers who are on the hook for buying AI systems differentiate the good from the bad risks?
So when you're going through and you're evaluating these models, what are the steps that you go to before it's ready for release? What's your checklist that says, okay, yes, this is ready? Yeah,
we've got a standard. It's called AIUC1, and that enumerates all of the possible risks and the things that could go wrong with the agents that we work with. And that's built based on real world incidents, what's already happened in the real world, what are the incidents that we've seen in the press and have led to losses. It's built on research data, so a lot of academics are researching how do models fail. Those failures don't necessarily show up in the real world, but they're valuable input. And then thirdly, it's built on just qualitative input from security and risk leaders across the enterprise and across the AI labs. And we consolidate all of that input into this one taxonomy of what are all the risks and what are all the attacks that we know work and should be tested for. And then having done that, we then map each of those to a set of preventative measures. what could you have done to prevent that risk from happening? So, for example, one very common failure that we read about and see a lot is data leakage. You see customers' real data being leaked, and that's happening because the guardrails, the filtering that allows that determines how the data is stored, is not appropriately filtering out, for example, the customer's PII. So that's one reason it happens. And the second reason it could happen is the AI agent has access to a system that it shouldn't have access to, and it's able to actually access that data. So great, we've got the incident. We understand how to test for that. We'll simulate those tests. We also understand what are the preventative measures that you could have put in place to prevent something like that with the filtering, with the system access. AUC1 enumerates these things. We go in and test for them. And then it's only once you've both passed the actual evaluations and proven that you have the right system safeguards in place that you can pass that requirement in AUC1. And this happens across the categories we have. So we do it for data, we do it for security risks like jailbreaks and prompt injections. We do it for safety risks like harmful outputs. We do it for reliability risks like hallucinations and tool calls, and so on.
Yeah, I think insurance is all about actuarial science and figuring out what's insurable, what's not. So you kind of walk through things that you could insure based upon but in this world, how do you determine what's not insurable, right? I mean, what's the level of risk of an underwriter would say, yeah, not yet, or no?
Yeah, and actually maybe a different way of looking at this is someone's always on the hook for the losses. The question is, have you priced it and have you appropriately managed for it, or is it silently there living on a corporate's balance sheet or at a systemic scale living on the federal government's balance sheet? And so we think the core challenge here and what we spend most of our time doing is really just how do we get the data? How do we collect the evidence that says how risky is the system? And then the underwriters obviously have their own underwriting guardrails. And it's okay if a system is not insurable as long as that is transparent and that is known to the buyer, who then says, okay, I'll take on the risk. I understand I'm not covered for this. But the first step, which hasn't been happening so far, is really about how do you actually determine what is the risk level? How risky is the system?
Right. And I think there's still some unknowns there too, right? I mean, it's, out of all things, I mean, other fields of insurance progress in sort of more of a linear fashion, and you have a lot of historical data. And sure, you do get data from AI, but because the models keep changing, the capabilities keep changing, in some ways the data that you have is a bit obsolete, right? Because it's was dependent upon an earlier framework or things are evolving.
Yeah, imagine trying to price a AI agent today based on data of the first release of ChatGPT. You would just be so far out of distribution. It's almost unhelpful and harmful to use that data.
Definitely makes statistical and model theory interesting in this regard. So switching gears, you talk a lot about a lot of these pilots failing for management reasons, but not model reasons. So can you unpack that a little bit?
Yeah, maybe actually one thing I'll first say is I think the right frame to use on AI pilots is actually these are experiments. And the reason I say that is if you treat it like an experiment, it actually is a good reminder that it's meant to fail. You're meant to try and take a risk, and you're meant to see what are the things that drive value, what doesn't. Let's kill the things that don't and iterate an experiment from there. So the idea of the MIT study that went viral last year, around 95% of pilots failing, and the idea of this being a shock, I think was a bit of a surprise to me, where I think it's great that enterprises are out there experimenting. It's great that 95% of them aren't working, because then you kill them early and you can go and focus on the 5%. And my advice always when we talk to business leaders is keep that experimentation. Don't expect 95% to succeed, because that will just constrain how creatively and the extent to which you're comfortable taking big swings on trying new ideas. So that's maybe the first thing. The second thing is these models are very, a lot of people talk about the kind of jagged edge of the models or of the frontier. Models don't operate like humans. You can't just take a human role and swap out a human for an agent or a model. But what you can do is you can say there is a set of activities that this human does that the model might be able to assist them with, or might even be able to do faster and better than that person could. So this requires really a manager or executives to understand that deeply and recut how the organization does work and how the organization operates, and then insert models into the places we know they're strong, and then create the right level of human oversight and support around them, and redeploy the humans onto other activities where they're helpful. All of that requires, I think, a deep human understanding of the organization, of the work that's being done, how it operates. And that's where I think just kind of plainly saying, well, the model failed, therefore the pilot failed, is much less helpful here than actually understanding the management challenges that came with it.
I mean, we see that a lot, right? Even though managers have broad scopes of responsibility, they don't often understand the nuances and the details of how their departments are running, the hundreds, if not thousands, of processes, the data points. They have a rough sense of what their team's doing and the outputs, but all those inputs that you would then potentially hand over to agents or other capabilities, there's that lack of understanding. So it's hard to manage what you don't measure or what you don't understand. So that's probably a start, right?
Absolutely.
There's always a joke in insurance, right? In case something happens, right? So that's what it's there for. But where does it fail though as a safety mechanism? You did talk about, okay, it helps that trying to determine who takes accountability, but are there times when it's just not going to get the job done and there has to be another measure?
Yeah, I think there are, you touched on this earlier, that there are obviously always going to be some uninsurable risks. There are always going to be some areas where you say, this just actually isn't sufficient because, for example, we're dealing with just minus health data and the stakes are too high to just say, I'm just going to transfer this risk, or I'm going to accept a 99% pass rate on this because the 1% is just too severe. You'll see this with critical infrastructure, for example, where you just need more nines of reliability before you're comfortable pushing that into production. And so this can't solve every problem, and you need that's where you need industry bodies, you need governments to really come together and say, how are we going to collectively solve this problem where you need it? But I think the vast majority of problems don't look like that, and they actually can be solved through third-party testing and insurance.
So, I guess if you're a capitalist, right, you could view this as its own new free market system, right? I mean, we see this with what happened with the housing crisis, right? I mean, people sold mortgages, they take risk-adjusted positions. It happens in the market all the time. People trade on futures, So depending upon what your level of comfort is, you are potentially willing or not willing to, you might invest to get singles, you might invest to get home runs and accept the failure. Is it the same then, or will it be the same with insurance? You'll get underwriters that will say, yeah, we'll take that bigger risk, but we're going to charge a bigger premium that goes with it.
Yeah, or even if you're a business, you can also then say, well, I'm a regulated bank, say, I can't take this kind of high risk system, no matter how helpful it might be. I can't take the risk that comes with that. But if I'm a tech company and not deploying in a B2B context with a human in the loop, great, I'll take some of that risk on. And so just like as you described, the kind of Moody's or S&P create ratings, and that creates transparency and facilitates the liquidity in the market. We think there's an equivalent here where just really understanding what are the risks, what is the level of risk, then allows the buyers and the underwriters to make informed decisions around this.
This is a highly emerging space, right? And you have standards and audits, and in some ways, you're seeing a market opportunity. You're coming forward as an independent body. But how do you also establish trust with people that says, okay, you guys should also be then trusted as this body to be able to provide this in a world that it's relatively new?
Yeah, we think about this a lot, and in particular, given how fast moving this world is, as you alluded to, it's very hard for the kind of traditional trusted bodies to often keep up with that. But also, there's a lot of companies out there that are not doing what they claim to. And so how do you kind of balance these things? Well, firstly, we do that by working very closely with security and risk leaders. So we work with a consortium of 250 security and risk leaders from across geographies, across sectors, and ultimately they're the ones who we draw on for the input, and they're the ones who hold us accountable around what goes into the standard. They peer review the standard, and they're the ones kind of really shaping the roadmap. Secondly, we work with our trusted auditors. So Shellman was our first accredited auditor. We work with Coalfire. There's a number of other auditors coming that will be announced soon, who are used to working with standards bodies. They understand what makes a good standard. They understand the failure modes and the risks with that, and they're the ones that can kind of confer the trust because they've been doing this for a long time. And then thirdly, and this is where insurance becomes very important for us, by working with insurers who we then tie up some of our financial incentives to the rigor of our standard and our auditing practices. So whereas without the insurance, we would have every incentive to actually water down some of the audits and the standards to just drive commercial outcomes. As soon as you tie the insurance to that and tie some of our revenues to that, we then have every incentive in the world to make sure it's rigorous, make sure it's tracking the right risks. And I think that's a very legible signal of trust for people to say, well, clearly if you're putting your money on the line, then I should trust it.
I mean, in a capitalist society without governance, there is incentive for businesses to not comply or to water down standards the second it's bad, right? Like we see this in manufacturing. Until they were required, they'll just dump waste, for example. So, if voluntary commitments get walked back, what's stopping, and what authority do you have, to say, okay, well, the market standard's not going to get watered down the moment something happens that's bad for business, or some kind of AI breach or something.
Yeah, well, again, I come back to the difference here is we have a financial stake in actually making sure that the standard is upheld, that there isn't a breach, right? If we're financially suffering because of that breach, we are absolutely not going to allow the standard to get watered down. And then the second thing is that consortium that we work with, who peer review every single change. There's a public change log that explains what is the change that happened in the standard, why did that happen. That really, I think, creates the transparency and accountability for us. And of course, you're absolutely right. Eventually, there will need to be a federal and an international framework around this. But these things just take time to create. And so how can the market run ahead and lay some of the groundwork for some of those standards?
So we've spent a lot of time talking about just the business model and insurance. As it relates to AI risk itself, you've been studying and practicing, working in this field for a long time. What do you see people getting wrong a lot of times as it relates to AI risk?
Yeah, good question. I think that I think there's like two failure modes I see quite a lot. One is misunderstanding the value that they can drive. So just because it sometimes makes mistakes doesn't mean you can never use it or you can't trust it in your systems. It just means you need to create the right scaffolding and the support around it. It means you need to create the human oversight and the human in the loop. Or you need to have a second AI that's checking the first AI, and that's going to drive down some of your failures. And I think that there, especially early days, there was a kind of overreaction to some of the hallucinations in particular that happened in systems. I think the second thing is, I think a lot of people are still underestimating just how prevalent AI agents and multi-agents and agentic systems are going to be in the very near future, and not preparing their risk management and their systems and their approaches for that world. I think there's a lot more you can already start doing if you really take that future seriously, around building the tooling, around figuring out what are your governance criteria and what risks are you comfortable with and not comfortable with given your business context. And I think a lot more investment should be going into that space right now.
So working with a lot of the frontier models as you have, you see people on both sides, right? You see people that want to go even faster. You want to see people that, no, this is the end of the the end of the world. Where's the line? Where does it actually land? Yeah,
I actually think there's a false tension between these camps. The analogy that often comes to mind for me here is nuclear energy, where an incident like 3 Mile Island really just shut down for an entire generation the progress of nuclear energy, and all of the benefits we could have had by really investing in safety were lost because of one incident. And I see this as something similar, where I think one big AI safety incident could just create a public backlash around it and significantly slow down progress. And I think that would be extremely bad for the world. So for me, the question is, how do we support progress whilst accelerating security? And I think these two need to come hand in hand, rather than the kind of tension between these two camps as you described them.
It's a good way of looking at it. A lot of people, I think they view insurance through different lenses. Sometimes they just look at it as a necessary cost, but it's also been involved in opening up industries, right? Automotive, air, electricity, internet. So when we think about AI, what you're doing now, what does this look like 10 years from now? And then what's going to break if people like you are not pioneering and we don't have AI insurance?
Yeah, and you've seen it after 9/11, when the terrorism insurance market dried up and economic activity just comes to a halt. People stop building, and that's where you've seen kind of governments have had to step in to really get the economy moving again. So from our perspective, the robust underwriting, the financial protection, the clarity over what risks are safe and what risk can you underwrite and what can't you, is essential for a free-flowing market, and it's essential to really drive American AI adoption.
So as AI continues to get, kind of in some ways it's already smarter than us, but it's going to get smarter all the time. How do you continually price the risk of something like that? Or is it just a metaphor that runs its course and it's just an acceptable model that we run with?
Yeah, at its core, we still know how to, at least in the current kind of generation of agents and even the multi-agent systems we're thinking about, we know what the cost of failures will be. We've seen data leaks, we've seen security failures in systems, and we understand if a security failure like this happens, what will insurers have to pay? Because they've been doing this for decades. And so really the question is, how accurately can you predict the likelihood of a failure? And that's where we just continue to run thousands of technical tests, and eventually we might need to run millions of technical tests. But that's where AI can actually help you to run those tests and stay ahead of the frontier. And as long as you're using the technology to keep up with the frontier and staying at the frontier of progress, I think there's a lot you can do to just keep gathering that data.
Do you ever worry about, from a probability modeling perspective, because there's a lot of talk about how do you know if an AI is drifting off course, it's hallucination. You measure the deviation from the acceptable outcome, and that's how you model it. But what if it's a small thing, right? That's sort of, it's like the wings of the butterfly effect that spreads out. So what if there's just some inherent error in the probability formula that is almost indiscernible at first, but then over millions of transactions and probability calculations, it ends up you're over here, right, versus somewhere else.
Yeah, and I think the thing that worries me most about this right now is there just isn't a good enough infrastructure for incident monitoring and overseeing the AI systems. So the risk is you wouldn't catch this early enough once the system starts to fail. And so from my perspective, one of the other things that insurers are very valuable at and they're incentivized to do is actually report the incidents, capture them, understand them, dissect them. And so the hope is, even in that scenario you describe, if you have a well-functioning incident report management and monitoring system in place, you can catch something like that early enough into the cascading before it becomes completely systemic across the economy.
Excellent. So to close it out, is there something you're paying attention to right now that most people aren't yet?
Yeah, actually, I think the thing you just described is pretty high on my list. I think there is a lot of focus right now on cyber and national security risks. I think bio is another concerning national security risk, and I'm glad these risks are getting more attention. But I think in parallel, there's economic security risks that are now emerging. What does this look like when AI is across all of our banks and embedded into our payments infrastructure across America? And how do we catch those failures in a fine-grained enough way to make sure that there aren't systemic risks that will emerge across the economy. And that's something we're spending a lot of time thinking about. And I think it feels like there's not enough thought and investment going into that space right now.
You've given us a lot to think about. So, Rajiv, thank you for being on Unscripted.
Pleasure.
All right, we'll have you back soon.